Hello everyone, today we will be studying about the topic evolution of banking laws in India. Introduction. The banking sector in India is one of the oldest and most important sectors of the economy. It has played a significant role in the economic development of the country since the pre-independence era. The Indian banking sector has undergone significant changes over the years and the evolution of banking laws in India. It is a reflection of the country's economic and social development. In this essay, we will discuss the evolution of banking laws in India in detail. History of banking laws in India. Banking laws in India have evolved over time, reflecting changes in the country's economic and political landscape. Here is a brief history of banking laws in India. First, the Reserve Bank of India Act 1934. The Reserve Bank of India (RBI) was established in 1935. The Reserve Bank of India Act 1934 provided the legal framework for its functioning. The act gave RBI the power to regulate the country's monetary policy, issue currency, and supervise banks. Second, the Banking Regulation Act 1949. The Banking Regulation Act 1949 was enacted to regulate banking activities in India. It gave RBI the power to supervise and control banks' functioning, and it also laid down rules for licensing new banks and the management of existing ones. Third, State Bank of India Act 1955. The State Bank of India (SBI) was established in 1955 under the State Bank of India Act 1955. The Act provided legal framework for the functioning of SBI and its subsidiaries. Fourth, the Banking Companies Acquisition and Transfer of Undertakings Act 1969 and 1980. These acts nationalized the major commercial banks in India, bringing them under a government control. In 1969, 14 banks were nationalized, and in 1980, 6 more banks were added to the list. Fifth, the Foreign Exchange Management Act 1999. The Foreign Exchange Management Act or FEMA replaced the Foreign Exchange Regulation Act 1973 and provided a legal framework for regulating foreign exchange transactions in India. Sixth, the Banking Regulation Amendment Act 2020. The Banking Regulation Amendment Act 2020 was passed to give RBI more powers to regulate cooperative banks. The act brought cooperative banks under the RBI's supervision. Overall, India's banking laws have been instrumental in shaping the country's financial sector, and they continue to evolve to meet the changing needs of the economy. Now we will study about the evolution of Indian banking system. First point, pre-independence era. The history of banking sector in India dates back to the 18th century when the first bank in India, the Bank of Hindustan, was established in 1770. The East India Company established several banks such as the Bank of Bengal, the Bank of Bombay, and the Bank of Madras, primarily to finance the trading activities of the British East India Company. These banks were mainly used to finance the trading activities of the British in India. During this period, the banking sector was largely unregulated and there were no specific banking laws. In 1895, the Indian Banking Act was passed, which brought all banks under the purview of the government. The act provided for inspection and regulation of banks and laid down the minimum capital requirements for banks. The Swadeshi movement inspired the Indian business community to form banks of their own from 1906 to 1911. A number of banks established then have still managed to survive till date, which includes Canara Bank, Indian Bank, Bank of Baroda, and the Central Bank of India. A landmark event which marks the evolution of banking happened in 1934 when a decision to set up RBI was taken. It started functioning on 1st April 1935. RBI has since been central bank of the country and regulator of banking sector. It derives its power from the RBI Act 1934. Now let's move on to the second part, which is post-independence era. After India gained independence in 1947, the government took several steps to regulate and control the banking sector. In 1949, the Banking Regulation Act was passed, which aimed to regulate the functioning of banks and prevent from engaging in risky activities. The act provided for regulation of banking companies, their management and conduct of their business. The RBI was established in 1935 and after independence it became the central banking authority responsible for regulating the banking sector. The RBI was given the power to issue license to new banks, regulate banks, merger and acquisition, and supervise the functioning of banks. In 1950s, 1960s and 1980s, the government nationalized several banks to promote the development of the economy. In 1955, the Imperial Bank was renamed to SBI and was nationalized. In 1969, the government nationalized 14 major banks whose capital were 15 crore. In 1980, six more banks were nationalized whose total capital were more than 200 crore. In 1993, the new Bank of India was merged with PNB and now total 19 banks were nationalized. Note that in these 19 banks, SBI was not involved. The nationalization was done to achieve the objectives of social control, credit allocation, and promote the development of rural sector. The government believed that nationalizing the banks would help channelize the funds from urban areas to rural areas where the need for credit was high. The nationalized banks were given specific targets to achieve, such as lending to agriculture and small scale industries sector. Now let's move on to the third part, which is liberalization era or the LPG era. In 1990s, the Indian economy underwent significant reforms and the banking sector was also not left behind. The government took several steps to measure liberalize the banking sector, including allowing private sector banks to enter the market, reducing government intervention, and allowing foreign banks to operate in India. In 1993, the Securities and Exchange Board of India (SEBI) was established to regulate the securities market. In 1994, the FEMA Act or Foreign Exchange Management Act was passed, which replaced the Foreign Exchange Regulation Act (FERA). The act provided for the regulation of foreign exchange transactions in the country. Recent reforms. In recent years, the government has taken several measures to further strengthen the banking sector. In 2016, the Insolvency and Bankruptcy Code was passed, which aimed to provide a time-bound and efficient mechanism for resolving insolvencies. The code provides a framework for the timely resolution and stressed assets to provide protection to creditors. In 2018, the government merged several public banks to create larger banks and improve their efficiency. The government has also taken several steps to promote digital banking and financial inclusion such as Jan Dhan Yojana and Aadhaar enabled payment systems AEPS. Conclusion. The banking sector in India has come a long way since the pre-independence era. The government has taken several measures to regulate and control the banking sector, promote financial inclusion, and promote the development of rural sector. With the recent reforms, the Indian banking sector is expected to become more efficient and competitive, providing better services to the customers. Thank you.
Do like, share, and subscribe.